When you see massive wealth on display, it is easy to assume it was bought with a massive, highly taxed salary. But people pulling in millions of dollars a year rarely hand over 37% of it to the government. The IRS tax code operates less like an unavoidable penalty and more like a highly specific rulebook. If you know exactly how the rules are written, you can maneuver right through them. For most people, financial drag comes from two specific directions. The first is ordinary income tax. This takes a direct, continuous cutout of the profits and salaries generated from daily work. The second is the capital gains tax. If you buy an asset, hold it while its value climbs, and then sell it to access the cash, the government steps in to take a substantial percentage of that growth. Standard earners are caught in the middle of these two forces. They rely on traditional cash flow from paychecks to live, and when they need a large sum of cash, their only option is to sell off their investments and trigger those liquidation taxes. Those at the highest financial tiers do not rely on standard wages or standard asset liquidation. They deploy a pair of highly specific, entirely legal financial maneuvers to sidestep both ordinary income taxes and capital gains. To handle ordinary income, business owners frequently turn to Section 179 of the tax code, often referred to in popular culture as the G-Wagon loophole. The IRS treats standard passenger cars differently than heavy equipment. If a vehicle has a manufacturer-certified gross vehicle weight rating of more than 6,000 pounds, it exits the normal passenger auto depreciation limits and enters the heavy vehicle rules. There is a strict guardrail here. To claim this specific classification, the vehicle must be used for legitimate business purposes more than 50% of the time. For the 2026 tax year, the rules pair Section 179 with a permanently restored 100% bonus depreciation. This allows a business to write off the entire purchase price of eligible property in the first year it is placed in service. This diagram shows the direct math. If a company in a 35% tax bracket buys a qualifying vehicle for $100,000, that full deduction instantly wipes out $35,000 in owed taxes. The deduction does have limits. It phases out dollar for dollar once a business's total qualifying equipment purchases for the year cross the $4,090,000 mark. And while the Section 179 deduction for heavy SUVs specifically is capped at $32,000, the remaining eligible cost of the vehicle is covered by that 100% bonus depreciation. This rule extends far beyond heavy luxury vehicles. Qualifying property includes manufacturing equipment, office technology, and off-the-shelf software. By utilizing qualified financing, a business can claim this massive deduction up front on their tax return, even if they have only made a minimal down payment on the actual loan. Acquiring this heavy equipment serves a distinct mathematical function. It converts taxable cash flow into deductible physical capital, neutralizing ordinary income on paper while accumulating real-world assets. That maneuver addresses ordinary income, but a different problem arises when wealth is tied up in a massive portfolio. An investor might have millions in paper assets, but still need immediate cash to fund a lifestyle or secure a new real estate deal. Liquidating those investments to get the cash triggers the capital gains tax. Depending on the bracket, the government will demand 15 to 20% of the profits the moment those shares are sold. To bypass this penalty completely, high net worth investors utilize a securities-backed line of credit, or SBLOC. Instead of selling their stocks, the investor pledges their diversified portfolio as collateral to a bank or broker-dealer. In return, they receive a revolving line of credit with a high borrowing limit and highly favorable interest rates. Executives with high equity compensation frequently utilize this. Elon Musk has pledged portions of his Tesla shares to fund his ventures, drawing cash from the underlying value of the stock without triggering the taxes of a formal sale. This chart compares the financial realities. The $7,500 cost of borrowing money is vastly cheaper than the $12,500 tax event triggered by selling the securities outright. Because the underlying assets are never actually sold, they stay active in the market. They continue to appreciate in value, and the investor continues to collect the dividends generated by the portfolio while the loan is active. This structure allows an individual to spend millions in liquid cash. Meanwhile, their net worth continues to compound in the market, completely insulated from capital gains taxes. These maneuvers require precision. Aggressive tax strategies draw scrutiny, and utilizing accelerated depreciation requires meticulous record keeping to survive an IRS audit, especially regarding proof of business use percentages. With securities-backed lending, the risk lies in the market itself. If the stock market drops suddenly and the portfolio's value plummets, the lender will issue a margin call demanding immediate repayment or additional collateral. If the borrower cannot produce the cash, the bank will force the liquidation of the pledged assets. This means selling off the portfolio precisely when the market is at its bottom, locking in massive irreversible losses. It raises an obvious question. Why does the federal tax code allow these vast sums to go untaxed in the first place? Accelerated depreciation rules are engineered specifically to stimulate the economy. The government offers the deduction to incentivize businesses to spend their cash reserves on manufacturing, technology, and equipment, which keeps supply chains moving. Securities-backed lending serves a similar macroeconomic purpose. It prevents founders and institutional investors from dumping massive blocks of shares just to generate cash, a move that could easily trigger broad stock market volatility. stability. The tax code is built around these incentives. Consequently, those with extreme wealth do not view capital as a static number in a checking account. They treat it as a dynamic tool, constantly converting cash into deductible physical assets and leveraging paper wealth into strategic tax-free debt.